And I'd be happy to clear it up for you if what I just explained wasn't clear. So let's talk about why policy loans are the most efficient instrument of credit that you can find out there. Well, there's no other credit instrument where the lender is also the guarantor of the value of the collateral of your loan. What the hell does all that mean? Well, I'll explain it to you. So what happens when you get a policy loan is this cash value is using your death benefit as collateral. With a mortgage loan, when you go to a lender, they can't guarantee if your house is going to be worth, say you buy a house for $400,000, they can't guarantee your house is going to be worth $400,000 30 years from now. It might be more, it might be less. They can't guarantee that. But what makes insurance companies unique is that they are contractually obligated to fulfill what your cash value is going to be, what your death benefit is going to be in certain periods of time, certain points in time, rather. That means that if your insurance contract says that you are going to have $350,000 in cash value by policy year 30, the insurance company is going to make sure that your policy is worth $350,000 by the end of policy year 30. There's no other lender, there's no other form of credit instrument that can offer that kind of guarantee. It just doesn't exist. The other unique thing about policy loans is that these insurance companies are guaranteed to be paid. Let me write this here. The insurance companies know they're going to get their money. Either you're going to pay it back or they're just going to take it out of the death benefit. Either way, they're getting their money. What happens with, say, like a mortgage, they don't know if they're going to get that money. Like, it's on you to pay, and they can't, like I said earlier, they can't guarantee what the house is going to be worth 5, 10, 25, 30 years from now. So that risk is built into the price of the credit that you're borrowing from that lender. So mortgage rates, you do have your standard mortgage rates, but you're also going to pay fees to that lender, and the risk is going to be baked into the price of that loan. Auto lenders don't know if they're going to receive their money from you. They can't. Your car is going to depreciate by what, 50, 60% as soon as you drive it off the lot. So they know they're not going to recoup that money if you don't pay. Insurance companies know for a fact that they will be paid either in the short term, or they're going to be paid once you die and they take it out of your death benefit. Either way, they're getting their money, so they're not sweating it. So I want to back up for a second. How is credit priced? Meaning, how does the risk get transferred to you? How do lending companies make money? Origination fees, points, application fees, rates, and other generally confusing terminology. Have you ever looked at a loan application? Try to figure out, if you're not in finance, if you're in finance, you know what all those words mean. But if you're just a normal person, like the two of us here, you're probably just thinking, what the hell do any of these words mean? Let's talk about rates, how they differ from a standard loan versus what they look like on a policy loan. So typically what's going to happen, you have two different types of loans. You have structured, you also have unstructured. So let's talk about what each of these mean. For structured, it means they're amortized. So if you're not familiar with what that means, that just means there's a payment schedule. So if you have, like you have your mortgage, say you have a fixed rate loan, you know what you're paying every single month unless something funky happens with your escrow or property taxes go up, insurance goes up, etc. So you're going to pay, let's say, $2,300 a month or whatever it is for 30 years, 12 times a year. What is that? 360 times, 360 payments. You know what you're paying every single time. That's what an amortized loan is. That's what a structured loan is. For unstructured, it's exactly what it sounds like. You set the terms, except for the rate. The only thing that you do not in control of with unstructured loans is the rate, the interest rate. So aside from that, you dictate the payment, you dictate timing, you dictate frequency. I guess that's similar to timing. So you can pay once a year, you can pay once a month, you can pay once a week, you can pay once every 2 years, whatever you want to pay. You're the owner of the policy, so you dictate the terms. How is this possible? But like I said earlier, the insurance company knows they're getting paid no matter what. So they don't really care when you pay, how much you pay, they're going to get their money regardless. So again, it's a non-issue to them. With structured loans, typically what happens with, let's talk about interest. With structured loans, interest compounds daily and accrues monthly. So what happens is exactly what it sounds like. For 30 days, you have a set specified amount of interest that's going to be added to your loan balance. And then at the end of that 30 days, whatever that amount of interest is, it's added on to your loan. So with these amortized loans, and this is also baked into the price of credit with traditional lenders, is the lender is receiving most of their money up front. Like you're not paying anything towards your principal for, at least with a mortgage, for quite a while. It's all interest for like 10, 15, 20 years, somewhere like something like that. It depends on how it's structured, obviously. But that's how these lenders make their money, is because all of the interest is up front because of this. Okay. Now, with a unstructured loan, something like a policy loan, your interest still compounds daily. But here's the difference, and here's why policy loans are so unique, is that it accrues yearly. So mathematically, what does this look like? Or in plain English, what does this mean? It means that you have a certain number, a specified amount of interest that accrues every single, compounds every single day for the entire year. And then at the end of the year, that interest is added on to whatever your loan balance is. Whereas with this, that process happens every single month until the loan is paid off. So you're talking about that happening 360 times here. Whereas this, say you take the same 30 years to pay off a loan, you're talking about it happening 30 times. So you can probably imagine the difference in interest that you're paying with this versus this. With this, it's quite low if you haven't figured it out already. So hopefully you can see why we're building the case that policy loans are by far the best form of credit that you can get, and they're not all bad. Okay. The reason that people get so tripped up with loans is because they hear Dave Ramsey saying like, oh, pay cash and everything, never take on debt, which is fine for a specific demographic of people. But people that are really wealthy know how to use debt to their advantage, and they can, take a loan at 8% and then make something like 10, 12%. And then they have a spread of that 4 or whatever the spread is. That's how this is achieved, is through something like this. All right, so let me back up a little. I went through and edited this. So I messed these terms up, so my bad, apologies. But anywhere you see compounds, it's accrual. Anywhere where you see accrues is supposed to be compound. I mixed those up. So with both of these, interest accrues daily, but compounds monthly or yearly. Compounds just means it's the amount of interest is added to the balance of the loan. So how does this work mathematically? So we have loan principal, or the balance, times the rate, times number of days outstanding, divided by 360. So the right here is that daily accrual with this formula right here. The way that this works is 100% of your repayments go to principal, unless you have some interest added to the loan. But if anytime you're taking out a loan for any reason, whether it's a policy loan, mortgage, auto loan, whatever, always have provisions to pay it back, or always have a plan to pay it back. Do not ever just don't repay back a loan, no matter if you can or if you don't have to, or if you have to, just pay it back. So with the policy loans, 100% of your payments go 100% to principal. Compare that with this up here, where a teeny tiny bit of your payments are going towards principal at the beginning, because you have this happening, this monthly compounding right here. In both cases, you have interest accruing daily, but in this one, it happens 12 times a year. In this one, it happens 1 time a year. That's a dramatic difference in the amount of interest that you're paying. Talk about the rates themselves. They can be fixed or they can be variable. Variable meaning they change, while you have the balance outstanding. Typically, hopefully you've seen some of my other videos. I'm not going to go in depth with it here, but if you have a fixed rate, you're dealing with a direct recognition company, meaning that you're going to get a different dividend percentage on cash that you borrow against versus cash that's actually in your policy. Meaning, if going back to the previous example, if you have $100,000 in cash value, you borrow 10, the insurance company will only recognize you having 90,000 in there until you pay it back. With non-direct recognition or with variable, typically that's what you'll see. With non-direct recognition, that basically just means that the insurance company is not going to recognize the amount of cash value that you borrowed. They're going to recognize it as still being in your policy. So if you have 100,000, you borrow 10, the insurance company is still going to count your policy as having $100,000 available in cash value. That's all that means. Now, as far as the difference in these two, as far as interest payback, or as far as growth goes, it winds up being about the same from a growth perspective. There's not really much difference between the two. So what I want to talk to you about here as we close out this video, hopefully that was a good enough breakdown for you to understand how policy loans differ from really any type of credit instrument out there. Now, as far as how we need to think about policy loans, is we need to stop comparing conventional loans to policy loans. They are in no way, shape, or form the same. So like I mentioned, if you remember with the conventional credit, it's a structured payment plan. There's also typically recourse loans, meaning that if you don't pay, somebody's coming after what you borrowed, or somebody's coming after what you bought. Somebody's coming after assets of yours in order to make sure that loan is paid back. So with a mortgage, they're coming after your house and stuff inside it. If there's a difference between the balance and the value of the house, for an auto loan, they're coming after your car. So with these policy loans, that you don't have that. I mean, you do, but it's coming out of your death benefit. They're not coming after any of your assets. So the insurance company's not worried about being paid. So as far as, what Dave Ramsey says and White Coat Investor and all these other folks, like, all debt bad. Well, no, like it's still debt, but if you're smart, you can leverage it in smart ways in order to, further grow your money and use, say cash value or proceeds from whatever you're using your policy loans for to pay your policy loans back, maybe even pay for some premiums, or, just have extra cash flow that you can use without, having to work more in order to get that extra cash flow. So let's talk about some features of policy loans. There are zero use restrictions. So with a mortgage, obviously you can only use that to buy a house. You can't, I guess you could take out a mortgage for, like kids' college, but generally speaking, like people aren't really going to do that. So there's no use restrictions. You don't have to meet a certain set of obligations for, a lender to view you as somebody that's suitable to borrow money. I understand why they do it, but whenever you're talking about getting credit, you're talking about having to jump through just a whole ton of hoops in order to get access to that credit. When you go to an insurance company to ask to borrow something, to borrow your cash value or to borrow against your death benefit, you just call them up and say, hey, I want to borrow X amount. They just say, okay, great. Where do we send the check? That's it. Done deal. You don't have to worry about underwriting. You're not having to jump through any hoops. There's no applications. You don't have to ask anybody for permission to borrow against your policy. It's your policy. You can do with it what the hell you want to do with it. There's nobody deciding how much of your payment's going to go to interest or principal. There's nobody telling you when you have to pay a certain amount back and when and how often and how much. You decide all that. There's no mandatory repayment schedules. But yet life insurance is one of the worst places you can put money. That was said sarcastically. Hopefully you picked up on that.